There is a ghost beneath the surface of global finance, a repeating specter woven through centuries of empires, wars, and commerce. It's a pattern so consistent, so inevitable, that every dominant global currency in history has fallen prey to it, not most, but every single one. From the Portuguese real that commanded the seas for 80 years before fading into obscurity, to the Dutch guilder that ruled the oceans for nearly another 80 and then disappeared, and the British pound sterling which reigned for over a century before succumbing it, is a cycle written in the bones of history. Each dynasty of currency believed itself eternal, convinced that their supremacy was unlike any before. Each was proven spectacularly wrong. The U.S. dollar assumed the mantle of the world's reserve currency in 1944, at the close of a war that reshaped the geopolitical landscape. 81 years have passed since. Today, in 2025, the dollar finds itself on a trajectory all too familiar, stage 5 of a 7-stage cycle that history has mapped out not once, but 4 times over 6 centuries. This is not mere speculation or gloomy prophecy. It is a mathematics of power and economics, a sequence that unfolds inevitably through deficits, debt, and the erosion of trust. The real question: are we so wise as to recognize the writing on the wall, or are we blinded by arrogance, convincing ourselves that this time, somehow, it's different? Let us journey through these 7 stages. The anatomy of every reserve currency's rise and fall, and place the dollar precisely where it stands today. But first, we must understand what it truly means to be a reserve currency. It's not enough for a nation's currency to be strong or stable. The reserve status signifies that it is the currency other nations hold in their central banks, the unit in which global commodities like oil and gold are priced, and the medium through which international trade balances are settled. It is the currency that every government, business, and central bank needs to function. Holding the world's reserve currency confers what economists call the exorbitant privilege. The reserve currency nation has the unique ability to print money and export it in exchange for real goods, essentially borrowing from the world at low interest. Other countries must export to it in order to accumulate its currency for reserves. Risk premiums on its debt shrink because the global demand for its bonds is structural, embedded in the fabric of international trade. It is the ultimate economic weapon, the strategic prize that empires have fought and collapsed over. Now, the 7 stages. Stage 1. Military dominance and control of trade routes. Every great global currency begins its journey with unassailable military power, not simply to wage war, but to control the arteries of global commerce. This stage is not about having soldiers. It is about dominion over the sea lanes, ports, and choke points that carry the lifeblood of international trade. In the 1450s, Portugal charted a course into uncharted waters. At a moment when most European nations still hugged coastlines, Portuguese navigators ventured boldly across oceans. When Bartolomeu Dias rounded the Cape of Good Hope in 1488, he opened a direct sea route to Asia that shattered centuries-old Ottoman control over the Silk Road and other land routes. With this maritime breakthrough, Portugal wielded a military advantage unlike any before. Armed fleets and fortified ports at strategic nodes: Goa, Malacca, Macau, and Mozambique. These were not mere trading posts. They were heavily armed fortresses controlling terms of trade, dictating tolls, tariffs, and permissions. Imagine the power embedded in these cannons and fleets where once merchants had many options. Now they had to deal with Portugal's real. It wasn't the gold standard or economic fundamentals that made that currency dominant. It was the threat of cannon fire. If you wanted spices from the Moluccas, you had to pay in Portuguese reals. The Dutch followed a remarkably similar script in the 1600s. The Dutch East India Company, far from a mere commercial entity, was a sovereign military power, with tens of thousands of soldiers and dozens of warships. It wrested control of key trading posts from Portugal and laid claim to the lucrative Spice Islands. Amsterdam emerged as the financial heartbeat of global commerce, with the guilder becoming the currency of the sea. And then came the British Empire in the 1800s. The Royal Navy was not just a navy, it was an instrument of economic hegemony. Its fleet outnumbered the next 5 navies combined. The phrase "Britannia rules the waves" was no exaggeration. Britain controlled the choke points, the Suez Canal, Gibraltar, the Strait of Malacca, the Cape of Good Hope, the strategic pivots of global trade. Without access to British-controlled sea lanes, international trade was bottlenecked, forced to run in the currency of the pound sterling. The United States inherited this mantle after World War II, with unmatched naval power and military presence deep across every major trade choke point. Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. The U.S. Navy's dominance is both a shield and a lever, ensuring that global commerce cannot function without American sanction, and by extension the dollar. This is stage one, where currency power is born in the thunder of cannons and the sovereignty over seaways. For the dollar, this phase was locked in by 1945 and continues to anchor Treasury's global role today. But history teaches us that military might is only the foundation. The story only begins here. Stage 2 emerges quietly but with seismic consequences: the establishment of financial infrastructure and global trust. Military dominance creates the space, but without the scaffolding of a credible financial system, a currency cannot become the spine of world trade. The Dutch Republic's ascent in the 17th century was no military fluke. It was the product of pioneering financial innovation. Amsterdam birthed the first true stock exchange, a marketplace for shares, bonds, and commodities, bringing liquidity and transparency unheard of before. The Dutch East India Company issued bonds and shares to a global investor base, allowing it to raise capital at unprecedented scales. Trust was engineered. Investors came to believe not just in the company, but in the reliability and stability of the guilder itself. Fast forward to the British Empire. The Bank of England's founding in 1694 was no mere bureaucratic gesture. It transformed England's war finance by issuing government bonds with credible backing, a promise etched in law and enforceable by courts. London became the beating heart of global finance. The British pound was bolstered by a world-class banking system and a network of colonial exchanges where the currency circulated with the ease of a modern cryptocurrency. The British government's discipline in managing debt, its willingness and ability to repay investors, cemented faith that the pound was more than just a unit of account. It was a storehouse of value. This stage reveals a crucial pattern. Reserve currencies thrive on belief, the collective faith of merchants, governments, and investors. It is a social contract writ large. Without trust, military supremacy is hollow. Cannon fire alone cannot back a ledger. The real and the guilder became instruments of trust as much as instruments of war. The United States capitalized on this stage with the Bretton Woods Agreement of 1944, embedding the dollar into an elaborate system of fixed exchange rates, where every currency pegged itself to the greenback, and the greenback itself was pegged to gold. This institutional edifice guaranteed convertibility and constrained arbitrary monetary expansion, at least in theory. But this stage also contains the seeds of future decay. Trust, once granted, is fragile. It demands discipline, transparency, and restraint, and it depends on more than unilateral military dominance. It requires cooperation. Britain's fiscal discipline eventually faltered under the weight of 2 world wars. America's gold reserves, though vast, could not keep pace with skyrocketing dollar holdings abroad. The system's cracks grew visible. Stage 2 ends not with the effortless expansion of a currency's use, but with the dawning realization that the architecture of trust is under stress. When confidence falters, the financial infrastructure built over decades begins to erode. This erosion is the haunting prelude to Stage 3. The demand for the currency grows beyond the impenetrable grip of gold or any tangible asset backing. The world wants dollars, real, physical dollars, but the U.S. Treasury and Federal Reserve begin to struggle to supply them without risking inflation and weakening the dollar's credibility. The tension here is deeply philosophical. What happens when the intangible pillars of trust, once fortified by gold and military might, begin to crack? When does a currency shift from a symbol of collective security to an emblem of reckless debt? This is the space where confidence is tested and cracked. The U.S. in the 1960s faced a dilemma it was unwilling to confront fully: expanding money supply to fuel domestic programs and an expensive war abroad, while maintaining the dollar's fixed parity to gold. President Nixon's 1971 decision to end the dollar's convertibility to gold, the Nixon shock, was an inflection point, a fracture in the narrative of trust. It redefined money from a tangible promise into a fiat abstraction backed only by government authority and geopolitical might. None of these moments were accidents. They echoed the same trajectory that the Portuguese, Dutch, and British currencies had taken centuries before. Military power lays the ground, financial institutions build the walls, but when economic demands outpace the safeguards of trust, the house begins to lean. We arrive at a profound crossroads not only for the dollar, but for the very concept of money. Is it a fixed token honoring real value, or a dynamic tool capable of infinite expansion and contraction? The answer dictates the fate of the reserve currency. As the world entered the floating exchange rate era post-1971, the dollar transformed from a gold-backed anchor into a fundamentally different beast. Its value became a function of market sentiment, economic policy, and geopolitical influence, a volatile triad with the potential to ignite crises or foster booms. The story now shifts toward the consequences of this divergence: the inflationary pressures, the burgeoning deficits, and the increasing reliance on foreign creditors. The next stage unfurls with an undeniable urgency: the unraveling of fiscal discipline and the emboldening of debt. Where the dollar once rested on unshakable guarantees supported by gold and arms, it now teetered on faith alone, faith tested by the relentless demands of a post-industrial, interconnected global economy. The question remains: will faith endure, or will it flicker and fade as it did for the currencies that preceded it? From the thunder of cannons and the command of the seas, the narrative of global currencies advances swiftly into its second stage, a phase equally vital, yet far less visible than battleships and blockades. Stage 2 is the economic metamorphosis, the consolidation of trade into financial networks, and the rise of capital markets that spread a currency's influence beyond warships and fortresses. Here, raw military dominance is transformed into an institutional and infrastructural supremacy that weaves the currency into the daily transactions of a global economy. For Portugal, the shift was subtle and fleeting. While their armed ports and cannons ruled the waves, their financial system remained archaic, fragmented, and ill-equipped to maintain long-term economic hegemony. Portugal's real lacked the deep capital markets or the complex instruments that would allow it to survive beyond the cannon's roar. As a result, the Portuguese empire faded not because they lost battles at sea, but because their economy could not support a global monetary architecture. Wealth accumulated in Lisbon was largely tied to plunder and trade monopolies, not to the creation of financial credibility. The Dutch, however, rewrote this script with the birth of modern capitalism. Amsterdam became the pulsating heart of global finance in the 17th century precisely because the Dutch created the world's first true stock exchange and pioneered joint stock companies. The Dutch East India Company, more than a military force, was a financial innovation, a company whose shares were bought and sold, whose profits were systematically tracked, and whose risks were shared widely among investors in a market that was transparent and liquid. This development embedded the guilder into the fabric of international commerce as a currency that represented not just military might, but financial trust. The guilder's ascendancy also depended on one overlooked, yet profound factor: the Netherlands' embrace of religious and intellectual tolerance. This openness attracted merchants, financiers, and thinkers from across Europe, turning Amsterdam into a hub where ideas, capital, and information flowed freely. This diversity diversified risk, cultivated innovation, and cemented confidence in the Dutch economy and its currency. The British Empire expanded this model on a global scale, combining it with an unmatched industrial revolution. London replaced Amsterdam as the center of finance because Britain built upon the Dutch foundation and added central banking and sovereign debt markets that were larger and deeper than any before. The Bank of England, established in 1694, was a revolutionary institution, a lender of last resort, a stabilizer of currency, and a creator of credit at unprecedented scale. By the 19th century, the pound sterling was not just backed by cannon fire but by the vast machinery of credit, insurance, and capital markets. British bonds were bought by investors worldwide, fueling railroads, factories, and colonial administration. London became the locus of financial clearing, settlement, and capital allocation for a globe interconnected by undersea cables and steamships. But economic dominance was more than markets and banks. It was a story of institutions, accounting standards, legal codes, and credit worthiness that shaped how value was measured and transferred. Britain exported not only goods but financial systems. Its pound sterling was the measuring stick of global trade and investment, because it was embedded in rules and practices followed from Buenos Aires to Bombay. When the United States took up the torch after World War II, it inherited an even more complex and robust financial ecosystem. The Bretton Woods system institutionalized the dollar's primacy by pegging other currencies to it and backing it with gold. The creation of the International Monetary Fund and the World Bank solidified American dominance over global financial governance. Capital markets exploded with new instruments, treasury bonds, eurodollars, derivatives, and Wall Street emerged as the centerpiece of global finance. The Federal Reserve became a global central bank by default, managing the dollar's supply and, indirectly, the liquidity of the entire financial system. But here, the narrative reveals its cruel irony. The very mechanisms that deepen a currency's reach, debt, credit, and financial innovation, also sow the seeds of its overextension. The synergy between military dominance and financial infrastructure in Stage 2 creates a fortress, but one with cracks. High leverage and reliance on confidence turn the monetary system into a delicate web held together by trust as much as by legal edicts or gold reserves. As the U.S. dollar's reach expanded through post-war reconstruction, Cold War alliances, and globalization, the American economy ran persistent deficits to feed the world's demand for dollars. This flood of liquidity fueled growth, but also accumulated vulnerabilities, a buildup of debt that history shows always precedes crisis. This is the magnification and paradox of Stage 2. The currency becomes indispensable, but the global trust it commands is fragile, dependent on continuous American financial strength and political stability. The tools that promote expansion, borrowing, printing, trading, also create potential for unraveling. Standing on the edge of what history identifies as Stage 3, the excess and overextension, we pause to consider a truth often obscured by narratives of progress and power. Currencies are not static monuments but fragile agreements between nations, markets, and expectations. The deeper question is not just how a currency rises, but how it secretly lays the groundwork for its own unraveling. As investors and governments chase the dollar's dominance, what cracks are growing beneath the surface? And how close are we to the moment when trust breaks, revealing the ghost of history waiting to reemerge? Stage 2 creeps in quietly, almost imperceptibly, yet it is a critical turning point: economic integration and the expansion of financial influence. Military supremacy lays the groundwork, but it is the intricate web of economic ties, trade agreements, investment flows, and credit networks that cements a currency's dominance beyond gunpowder and steel. For a currency to truly become the world's reserve, it must immerse itself in the arteries of everyday commerce, embedding itself in the balance sheets of banks, the treasuries of nations, and the ledgers of multinational corporations. Look back to the Dutch Golden Age. Following their bruising naval encounters, the Dutch didn't merely rely on battleships to maintain supremacy, they innovated financial markets. The Amsterdam Stock Exchange, founded in 1602, was the world's first official stock exchange. It transformed capital allocation and created liquidity where none had existed before. The guilder's dominance wasn't accidental. It was the consequence of a financial ecosystem that connected merchants, investors, and governments in an interdependent network. The Dutch East India Company's bonds and shares became the first widely owned global securities, establishing trust and confidence in Dutch financial instruments. Britain, as the Industrial Revolution powered forward, seized this lesson. The British pound sterling was no longer just a currency of kings and colonies. By the mid-19th century, London had become the global financial capital. Steam-powered ships ferrying cotton and tea, networks of telegraph cables linking trading centers, and the burgeoning London Stock Exchange all combined to integrate the world's economies under the pound's shadow. Britain used its financial might to attract capital, lend money, and manage debts across continents. British banks financed railroads in India, mining in Africa, and plantations in the Caribbean, creating financial dependencies that transcended the battlefield. The pound wasn't just a currency, it was the connective tissue of an empire that spanned the globe. The United States followed suit. Post-World War II, under the agreements forged at Bretton Woods, the dollar became the linchpin of the reconstructed world economy. The U.S. opened its markets and created institutions like the IMF and World Bank, which tied economic assistance to the acceptance of dollar-denominated systems. American financial markets grew vast and liquid. U.S. Treasury bonds became the benchmark for risk-free assets worldwide. The post-war era was a time when the dollar became not only a currency, but the bedrock underpinning global commerce, investment, and recovery. Yet here lies the fragile truth. Stage 2 depends on binding other nations into a system where their fortunes rise and fall with the currency bearer. Trust, liquidity, and financial innovation keep this stage alive, but cracks are inevitable. The more deeply intertwined the world becomes, the more pressure builds beneath the surface. Overdependence on one currency sows vulnerabilities that no fleet of ships or army can defend against. The emotional core here touches the human element. Abundance breeds complacency. Nations embracing the dollar as a force of prosperity ignore the undercurrents of imbalance accumulating quietly. The U.S. imports more than it exports. Its trade deficits balloon while its government borrows relentlessly. Consumer confidence, corporate profits, and geopolitical clout all feed off the available liquidity, the exorbitant privilege, while the weight of debt escalates. Strikingly, history reveals a paradox. The very financial networks that create dominance also catalyze decline. The Dutch Republic and Britain, riders on waves of credit and trade, found that Stage 2's success eventually slowed into overreach, excessive lending, speculative bubbles, and the piling up of foreign obligations eroded confidence. Stage 2 is the calm before the storm, a time of prosperity but also of mounting fragility. As the U.S. stands today, with soaring national debt surpassing $35 trillion, persistent trade deficits, and an electorate divided over the costs of military engagement and economic policy, Stage 2's delicate equilibrium is under unprecedented pressure. The question lingers in the minds of those watching, economists and citizens alike. How long can this system endure before cracks widen into fractures? What triggers the transition to Stage 3, overextension and speculative excess? When does confidence tip into doubt? When do holders of the dollar begin to question whether the foundation on which the exorbitant privilege rests is unshakable or unsustainable? These are not abstract concerns. They are the prelude to crisis, the moment when the narrative of prosperity collides with the harsh reality of markets, politics, and human nature. Understanding this, the story of reserve currencies demands we look beyond battleships and balance sheets, to the fragile psyche of nations and markets entwined in a global dance of trust, power, and perception. The shadows lengthen as the dollar teeters on the knife's edge of history yet again, and the lessons of the past loom large in the twilight. Stage 2. Establishing financial infrastructure and institutional trust. After seizing control of the seas and trade routes, the second act in this relentless currency saga unfolds in the realm of finance, where guns and ships alone cease to be enough. Having established unrivaled military dominance, a nation must then construct the financial architectures that bind the global economy to its currency, embedding trust that endures beyond the battlefield. For Portugal and the Dutch Republic, these were embryonic steps. Portugal's maritime empire generated enormous wealth, but its financial institutions remained rudimentary, unable to fully capitalize on the momentum of military conquest. The Dutch, however, crafted something entirely new, and in doing so, transformed the mechanics of global finance forever. Amsterdam became the nucleus of financial innovation in the 17th century, spawning the world's first modern stock exchange and the issuance of government bonds to fund perpetual empire. The Dutch East India Company's pioneering model, issuing shares to private investors backed by state power, emerged as a formidable hybrid of commerce, finance, and sovereignty. The guilder was no longer merely a medium of exchange backed by cannon ports. It was backed by an unprecedented confidence in market mechanisms overseen by the Dutch Republic's robust financial institutions. With each tick of the Amsterdam Stock Exchange's ledger, the guilder's claim to reserve status solidified, no longer just the currency of the seas, but a global standard for credit and trust. This was financial power as strategic leverage, silently weaving itself into the fabric of the early modern world economy. The British Empire leapfrogged this model a century later, institutionalizing an even more sophisticated financial ecosystem. The Bank of England, founded in 1694, became the linchpin of a vast and complex web of credit. It issued government debt on an unprecedented scale, financing the British military machine and industrial expansion in perpetuity. London eclipsed Amsterdam as the preeminent financial capital, and the pound sterling transformed into the currency in which global trade was increasingly denominated during the 19th century. Trust was no longer merely transplanted from military might. It was codified in contracts, central banks, and expansive credit markets that bound the British Empire's colonies and trade partners inextricably to sterling. Behind this lay an emotional and philosophical underpinning. Trust, the fragile, invisible substrate of all money, was cultivated not by force, but by carefully engineered institutions capable of managing risk and ensuring liquidity. The British understood that economic might extended far beyond warships. It resided in confidence, in the belief that tomorrow's debts would be honored, that the pound would maintain its value even across continents and generations. America's ascendancy to reserve currency custodian after 1944 was built on this hardened tradition, but with a 20th century twist. The Bretton Woods Conference forged an institutional architecture, infusing the dollar with trust backed by the full faith of the U.S. government, and the gold standard, for a fleeting moment tethering paper to tangible wealth. Post-war confidence in American productivity, technological innovation, and political stability created a financial ecosystem centered around Wall Street, Treasury bonds, and institutions like the International Monetary Fund and World Bank, both creations and extensions of U.S. financial hegemony. Yet as history unfolds, Stage 2 contains the seeds of future decay. The very mechanisms that create trust become vectors of overreach. The incessant issuance of credit and debt financing under the guise of stability obscure a growing divergence between paper promises and economic reality. The transition from gold to pure fiat currency in 1971, decreed by Nixon, was a pivotal fracturing moment. Trust was now an article of faith, stripped of a physical anchor. Here lies the paradox of reserve currencies. Their financial might demands ever-expanding credit and liquidity to maintain global dominance, but this relentless expansion erodes the hard boundaries that originally grounded confidence. Nations grow dependent on dollar liquidity. Global trade grinds on dollar credit lines, yet each additional dollar minted chips away at the latent trust underneath. When that trust stretches or frays, investors and states begin to question the currency's reliability as a store of value and medium of exchange. The story deepens. The crisis of faith in reserve currencies is not instant but insidious. It gnaws over decades, accelerating only after the initial foundations of trust, military power, and financial infrastructure have ossified into rigid structures prone to decay. The emotional dimensions emerge here. Collective global anxiety, the unsettling sensation of a once unassailable cornerstone beginning to crumble, eroding the collective conviction that anchored an entire world order. What happens when trust falters, and that invisible glue holding together trillions of dollars in debt obligations loosens? When nations start seeking alternatives, when opaque financial innovations mutate risk in unforeseen ways, how fast does the system unravel? The dollar, for all its might, finds itself on this knife edge as we speak. How the U.S. navigates this erosion of confidence will define the future trajectory of not just an economy, but the global balance of power. And so, the cycle trudges onward, from the thunder of cannons to the quiet ticking of balance sheets. But history warns us, even the most elaborate financial systems cannot indefinitely disguise the consequences of unrestrained expansion and the debt it engenders. Stage 3 awaits. It is a realm where excessive debt, deficit spending, and political compromise signal a turning of the tides. The currency's brilliance dims as fragility intensifies. The question is no longer merely whether trust will hold, but whether the dominant nation can resist the corrosive allure of borrowing beyond its means, and if the world's appetite for its currency will endure. The cryptic dance has started anew. The dollar's future hangs in the fissures beneath global finance, and only the next act will reveal whether it crumbles like those before it, or surprises the skeptics once more.